Good evening and welcome to our today's session. Today we are finalizing topic 1. I just wanted to look at evaluating a project of unequal lives. There before we were doing the techniques of measuring risk. We did simulation analysis. We have done decision tree. We have already done certainty equivalent coefficients. We have already done capital rationing, utility. We have done all the techniques required for you to measure the risk required by the examiner, and it's upon you now to do the revisions, and you continue checking whether you can be able to do the questions required by the examiner. Now, I just want us to go straight by checking on evaluation of projects of unequal lives. And we are saying that mutually exclusive projects are those that cannot be undertaken simultaneously, so that the choice of one in investment rules out all the others. Where mutually exclusive projects are of unequal lives, the NPV alone cannot be sufficient in determining which projects to undertake. Now we are saying in this case, we adjust the normal NPV using any of the following methods. One of the key methods is the annual equivalent value approach, and the other one we normally talk about the replacement chain analysis. Now, when you look on the equivalent annuity approach, we are saying that where this method is basically applied, we start by computing the NPV of the project in the normal manner. Then we determine what's known as the equivalent annual value. This can either be equivalent annual cash inflow or equivalent annual cash outflows. And we are saying if NPVs are positive, we shall determine the equivalent annual cash flows as follows. In this case, we normally say where the EFV, which we have called it as the equivalent annual value, we normally take the NPV, that is the net present values, we divide by the present value interest factor annuities, we discount by n years r%, but we are saying that where the NPV is the net present value of the project, we are also talking about the N, which is the useful life of the project, and the rate, our R is the cost of capital. But we are saying a project that promises the greatest equivalent annual cash inflow shall be recommended, and where the NPV are negative, we shall derive the equivalent annual cash flows as follows, as known as the equivalent annual cost as follows. We are just going to be following the similar criteria. And down there we are saying, in this case, a capital investment that minimizing cash outflow shall be undertaken. And that is basically when we are working with our costs. We have to be looking on the project that is going to be minimizing our costs. Then we shall be able to recommend it to the management. Now, let me just share my board so that I can be able to show you how these questions are basically done. And the question is here with me. We are talking about an illustration which I wrote earlier on regarding to the annual equivalent value approach, and we have said under the illustration it reads XY Limited is considering undertaking one of the mutually exclusive projects X and Y, right? We are saying both projects require initial cash outlay of Kenyan shillings 1 million shillings. Investment X will have a useful life of 3 years, as you can be able to see here, whereas investment Y has a useful life of 4 years. And in this case, we are being told the annual net operating cash flows for both projects are as below. We are being given them there. We have the project X and we have project Y. Project X has some cash flows there, which is given as 400. We go to 450. The last one is 500 shillings, and you can see under the projects, under these projects, there is nothing appearing under the project 4. When it comes to the project Y, you can see we have 350 throughout, which apply the basics of annuities. Now, from there, we have been told both projects have a no reset value at the end of their useful life, and the cost of this project basically The cost of capital, sorry, is 10%, but required, we are being asked by the examiner, using the equivalent annuity method, can we be able to determine which project should be undertaken? Now, in this case, when this question pops in your papers, which you are going to be doing there, and you just want to do, you're just going to be looking on the concept and how it is. The concept is going to be applying the aspects required. So in this case, let me talk about having a discount factor here. So let me look for a solution. Our solution should be looking like this, right? So in this case, let me see it. We have years by your side here. You have year 1, 2, year 3, and year 4. And we have 400, correct? So we have 450, and then we have 500. Here we don't have anything. Using the cash flows is provided for X, I need someone to give me the discount factors, at 10%. You're going to be getting our present values. You're going to be getting the present values at the end. Someone to give me the discount factor for lump sum, because you can see these cash flows for X are irregular, right? They are normally called irregular cash flows. Someone to give me the answer, please. Someone to give me the answer here. What are the discount factors at 10%?
0.091.
0.0901, right? Is something looking like that, The second one?
0.8264.
0.8264. The third one?
0.7513.
0.5173. Right? We don't need to calculate the last one. Can you give me the present values? 0.75.
300.
363.
63.6.
Points?
It's like 64.
0.64. The next one? The next one?
371.88.
Thank you so much. Next.
375.65.
375.65. Then what is the present value here? What is the present value of the cash inflow? How much are you getting there? What is your NPV? Sorry. When you multiply, how much are you getting there? Iko sawa. How much is it? The present value of the cash inflow? So how much? Hello? How much it is?
$11.11.
11 point what?
0.17.
0.17. Then you list your initial, please. Your initial place is how much? And see, we have an initial outlay of 1 million. Right? What is my NPV? What is my NPV? Is 111.17. 111.17. 111.17. Now, when you're calculating your EAV for X, let me start with X here. Equivalent annual value for X, we have said we normally take the NPV of the project. You divide it by what? We have said we normally divide it by the present value interest factor annuity, right? R% N years, right? So the NPV of the project is how much? The NPV of the project is how much? We have said the NPV of the project is 111.17. We divide it by the present value, interest factor annuity, R which is 10%. Is it 4 years or 3 years? The project A, as per the question we are being told, it normally has a useful life of 3 years. Now, who can be able to give me this factor? Using the formula for Brenda now, you normally use 1 plus R raised to a negative N, you divide by R. So the EAV for X will be 111.17 divided by what? Rosalind, how much is the present value interest factor annuity? How much is it?
2.4869.
Rosalind, how much it is? Anyone who cannot be able to use this formula now, I don't know whether we should be proceeding to the second topic of our syllabus. If you cannot be able to apply this formula, and they have been teaching you, I don't think if you should be proceeding to the next one. 1.10 we raised for negative 10. Is it 10?
7.
Sorry? The other should be?
Three.
Let us cooperate, please.
2.4869.
2.4869. What is your answer here? What is your answer?
44.70.
Sorry?
44.70.
44.70. 44.702. Right? Or you can talk about Kenya shillings, 44,702. Multiply by some thousands of shillings there. Now, let us do for the annuity aspects here. Let's do for annuity. This is very simple. That is for lump sum. Let us look for annuity. So the number of years is 1 to 4 years. As per the question, we are going to be receiving a cash flow of how much? 350. We have a discount factor at the rate of 10%. We get our present value. Someone to give me the discount factor for 4 years. This is annuity, Brenda. This is normally called the annuity. The formula to apply, we have it there.
3.1699.
3.1699. What is the present value? When you multiply your cash flow of 350.
$1,109.45.
1,109.65.
45.
Now, let us take our initial play. Our initially is 1 million. What is your NPV here?
109.49.
109.45. Calculate your EFV for Y. EFV for Y. You take 109.45. You divide it by 3.1699. How much are you getting there?
$34.53.
Or equivalent, you can write it as that 4,534. I know you can be able to get that. That 4,534. This is what you can be able to get at the end of the day. At the end of the day. That is how you normally do the question regarding to the annual equivalent values approach. That is how you can be able to do them. Right?
Yes.
Very good. I know that you can be able now to advise, because there you have been told using the equivalent annuity method, determine which project should be undertaken. When you compare between the equivalent annual value between 44,000 and 34,000, which one can you be able to advise this organization to invest in? Advice. You say what? Project what?
Project X.
Project X is acceptable. Very good. Project X is acceptable because it promises
High returns.
it normally promises what? Because it promises the greatest equivalence
Return.
It normally promises the greatest equivalent value, equivalent annual value compared to Y. Are we together up to this? Are we together?
Yes.
Yes, we are together, so that we can be able to go to the replacement chain analysis. I know we are together with others who are even not here today. I know now we can be able to check on the replacement chain analysis, and we are saying very well that this method is also known as the constant scale finite period replication criteria. The method involves an evaluation of the project over their shortest common periods. Where this approach is basically used, we are saying it uses or it assumes that each project will replicate with the same cash flow in each cycle over the shortest period of time. But we are saying for this reason, the NPV of a project in each cycle shall remain constant. And the net present value for both projects is normally determined, and hence we are saying that a project that promises the greatest net present value over their shortest common period shall be recommended. And we can be able to look on the how the replacement cases normally works. There is a question which they brought in May 2017. There is a question there, question number 5B. We can just go there. I know most of you have their past papers, right?
Please share the past paper.
Okay, we can do so. So let us look. Let me just look for the question first. Tuache Mesha kakitusomea, I will be able to share. We should be having a reward here. Should be getting rewards for FM. FM is very simple. I hear students going around and they are saying AFM. The people who are saying FM is hard, they have never done AMA, right? Those are saying FM is hard. They have never tried doing advanced management accounting, right? right? If you have ever tried and you compare, right, between those questions, we'll be able to realize AFM is even better. Which question is this? Let me check. It should be question number 5B. Question number 5, very good. Very good. And when you look on that question, imagine, let me just tell you something for the students here. If you are able to do one question and you score all the 12 marks, for example, ndio ujue venye mnaanguka mtihani. If you are able to score 12 marks, right? And then you count the theory, which you can be able to get on an advanced paper, advanced, for example, financial management, and then I can be able to attest that that theory can give you around 25 to 30, right? So you just need that question and a half for computation. Then you score everything. You score everything for theory, right? Then you have 50 marks. You have 50 marks. Let me come back to Chuma Limited. That is May 2017. Question is question 5B. Then we are being told, Chuma Limited operates a machine which has the following, you're being told it has the following maintenance cost and the resale values.
Please share the paper. Share the past paper.
Sorry. Let me reshare. Well, someone should have shared these papers. No, we have some students here. We have some students who are always silent. Huh? Let me check on that. Okay. There are those students who are keeping asking Mwalimu, can you be able to reshare the video? Kwani simu mnaibiwa kila siku? Simu zinaenda every day.
Huwezi elewa.
Ama wenyewe wamechukua. It might be wenyewe wamechukua. Ndio tuko ile mwezi mbaya sana ya makasiriko. Now, Chuma Limited operates a machine which has the following maintenance cost and resale values over its 4-year life. The purchase price of the machine is estimated by the way to be 25 million. I can see we are being given year 1 to year 4. They have given me maintenance cost for all the respective 4 years. We have the resale value at the end of each year, and then the company's cost of capital is 10%. And the examiner is asking you something very simple here. Can you be able to advise the management of Chuma Limited on how frequent the machine should be replaced? And I just want to start, because you can see our project has 4 years, it has a 4-year period. Then is it possible for you to check, to compute, for instance, the NPV, and then we calculate the equivalent annual value for the 4 years? Can we be able to do that? I know we can be able to calculate the equivalent annual value for all the 4 years, and then we are going to be advising whether the Chuma Limited, which projects are they supposed to be investing, and what is the reason for our advice. That one we're going to be doing straight away. I just want to start with 1 year replacement value. 1 year. We start with that is how you do it. We start with the first year. I know that you have opened the question, as I have done from my end, right? And the way you are going to be arranging the question of viewers, itakuwa inakaa namna hii. Kwa swali yako itakuwa namna hii. Let me show you right now. So we are going to be starting with year 1. We start with year 1 now. We say, very simple here, we say, can we be able to take the replacement? 1 minute, I just want to have bigger pictures for the angle. Very good. So, allow me just to start with the 1 year, 1 year replacement. We start with 1 year replacement cycle. 1 year replacement cycle, right? Let us take, because of the essence is to compute the NPV. The essence is just to compute the NPV. You have now year 0 and year 1, right? We have shillings in thousands here, and also you put them here, correct? What are the costs affecting those periods I have stated there? I can see in the year 0, we have only 25 million because here is where we normally discuss about the initial outlay. So what is the cost of the assets? The cost of the assets, as per the question given, is 25,000. Now 25,000 is negative, correct? What about the maintenance costs? Maintenance costs. So the maintenance cost only appears to year 1, and that totals to 7,500. Remember, these are costs to you and to the organization you are serving. But we have a resale value. That is the cash in, resale value. We don't have a resale value at year 0, but we have a resale value at year 1 amounting to 15,000. You ask yourself, what is your net cash flow here? Net cash flow. Net cash flow at year 1 is 25,000. Correct? Year 1 is 25,000. And when you take the difference here, you are going to be getting 7,500. Correct. Now, someone might want to calculate the NPV. Are we together? If you want to calculate the NPV, take the years. You have your cash flow. Correct. Then we have the discount factor. I know now we are talking about a discount factor at 10%. We get the present value. The discount factor we are using as the cost of capital. In this case, we start with year 1, or we start with year 0 now. Year 0, 25,000, which is negative. Correct. The discount factor year 0 should be 1. Then here you should be getting a present value of 25,000, which is negative. Then we go to year 1 now, where we are discussing about a cash flow of 7,500. Right? When you look on this cash flow, right, it is in form of annuity. It is in form of lump sum. We are going to be getting 7,500 once. So the formula for lump sum, we know it is 1 plus r raised to a negative n. So it is 1.1.
0.991.
Thank you. 0.9091. Then you multiply that with the 7,500. We are getting 68, 18 something, 0.25. What is your NPV? What is your NPV here? Our NPV is 18,181.5. This is negative.
Negative.
Is it negative? It is. Now, after you finish that, you go to number 2. You talk about 2-year replacement cycle. Right? Replacement cycle. Tutafunza hivi mpaka tumalize syllabus. Tutafunza namna hii. So it is upon you now to score everything. Now, when you talk about a 2-year, hauna mbio, unakuja unasema, let me take the number of years now. We are going to be incorporate year 0, 1, and 2. Correct. So there's 0, 1, and 2. Then let us look on the cost of the asset. You just repeat what we have done up there. So the cost of the asset only appears at year 0. Here it is dash and dash. Then we look on the maintenance costs. Maintenance cost. When you look on these maintenance costs, right, you're going now to capture for year 1 and year 2, because the project is going to be incurring that 7.5, and then year 2 is how many? Year 2 is 11,000. 11,000 there. Then we look on the resale value. How much is my resale value? I can see the resale value which is going now to be captured here. You're not going to include for year 1, right? Because our project is going to be replaced at year 2. So in this case, you ignore this one, you ignore for year 1, but you're going to be capturing for year 2 now. Year 2, we are getting a resale value of 10,000. What is your net annual net cash flows? Now, here we have negative 25,000. Here we have negative 75,000, right? 7,500, sorry. Then the last one we have negative 1,100. Negative 1,100. Now, take your number of years here to calculate the NPV. You have the number of years. You have your cash flow. Najua kuna mahali hapa kuna chomeka. Then we have the discount factor at 10%. Then we have our present values. So we start at year 0. The cash flow is 25,000, which is negative, is our initial outlay. Discount factor that year, it should be 1. You're getting negative 25,000. Now we go to year 1, negative 7,500. When I look at it, the discount factor, I'm not going to be repeating to compute it. It should be 0.9091. 0.9091. I think that one we were able to get how much? 7,500. Okay. I know it should be negative 68.25. You can just be able 6818.25. Just try to compute. I'm just copying something. Then we go to year 2, and at year 2, you can just be able to check it here. Year 2, we had a negative 1,100. Year 2 as 10 is how much?
0.8264.
0.8264. When you multiply with your cash flow, how much are you getting here?
Nine or nine.
Sorry?
909.1.
Nani amedanganya mwingine? Unaambiwa ngapi? 909.
Yeah, it's 909.
Negative 909. Point what?
Yes, 1.
Point 1. Hapa ni uongo kabisa. Hapo ni uongo kabisa. 11,000 minus 10 should be 1,000. This should be coming to negative 826.4. Then you give me the NPV here. The NPV should be how much? How much is this? Negative how much? Mimi nimepata kitu inakaa namna hii. Kama iko wrong unanisamea. That is what I have gotten. 32,644.65. Let us go to number 3, where we are discussing about 3-year replacement cycle. 3-year replacement cycle. So what are we going to be factoring? Year 0, 1, 2, 3. Very simple job here. So we start with the cost of the asset. The cost of asset, yes. This is 25,000 negative. We are going to be incurring that cost once. Then we go to the maintenance. Maintenance costs. Year 0, we don't have any. Year 1, we have 7,500. Year 2, we are going to be taking what? It is 11,000. Year 3, how much do we have? At year 3, I could be able to see we have a maintenance of 12,500. Right? Then we have resale. A resale value, right? Tuna capture tu ya year 3, yenye tunafanya replacement yake. Year 3 iko na ngapi? The resale value for the end of year 3 is 7,500. Sorry. So what is your net cash flow? My net cash flow will be looking like this. Here we have negative 25,000. Here we have negative 75, negative 11,000. Here we have negative what? Oh my goodness. It should be negative 4,500 there, if I'm not wrong. It should be negative 4,500 there. Is it negative 5? No, it should be 5,000. 5,000. Now, let us compute our NPV. We take the number of years. We have year 0, 1, 2, and 3. Cash flows. Our cash flows we have, year 1 is negative 25,000. Year 2, negative 75. Year 3, negative 11,000. Year 4 is negative 5,000. The discount factor, we said at 10%. I know for the first two. The first one is 1. The second one should be how much? 0.9091. The other one is 0.864. Then the third one is how much?
0.7513.
0.7513. Thank you so much. Let us get the present values. Ya kwanza mimi najua. Ya kwanza hapa najua. This is negative 25,000. What about the second one? The second one is how much? Negative 68. 18.25. The third one will be how much? Third one should be how much? Am I too fast? Am I too fast? Naona vitu rahisi. Ndio maana I'm not naenda mbio kidogo. 37.56. What is our NPV here? Are we getting something closer to that? Someone to show the answer, please. We got something closer to that for year 3. Kama nimekosea, naona nimekosea vizuri sana. Naona nimekosea kidogo. It should be 44,000 or something, someone? What is the summation? Hello? Are you getting something like that? Hello? Hello? Are we together? Are we together? Nimebaki peke yangu. Let me see.
Yeah, the answer is correct. It's correct.
Sorry?
It's correct. I'm getting the
Okay.
same answer as you.
Sawa. Let us do the last one for 4 years. For 4-year replacement cycle. For cost of assets, you can see here the K25, not applicable to the other years. The maintenance cost, I can see year 2 we have 11,000. Year 3 we have how much is year 3? Let me check. 12,500. Then year 4, I can see we have something very interesting. How much are we having for year 4? We are being given 15,000. 15,000 there. Right? 15,000 there. Now, what about the resale value? The resale value, we only pick for year 4, amounting to the resale value of 2,500. A resale of 2,500. Remember, these negatives. So how much are you getting here?
The year 4 explanation.
Sorry?
Pardon the year 4 explanation.
For which explanation?
Year 4 replacement cycle.
Ask your question, please.
Pardon the explanation from the beginning.
I have said that from the, oh my goodness. Sasa unauliza swali tukimaliza. Huyu ni nani sasa? Wacha nimtafute. Esther. Esther, do not have to explanation here. We have said we just want to compute the, it is normally, the method is normally called the replacement chain analysis. And we have said that the method basically is normally called the constant scale finite period replication criteria. So the method is basically involves the evaluation of the project over their shortest common period. So when we're looking at it, we are capturing the cost of assets, which is applies to year 0, right? Then the maintenance costs are going, because if the project is taking 4 years, then it means the machine has to be maintained year 1, year 2, year 3, and year 4. That is why you can see we are capturing the maintenance cost for the respective years as per our computation. Because when we were doing the first year, we did the maintenance cost for only 1 year, right? When we were doing for 2 years, we captured year 1 and year 2 because that cost has to be incurred and the machine is not generating any value, right? Every time we are going to be reselling, then you cannot be able to capture for the other respective years, because if it is the resale value at year 4, the resale value of your phone in the first day is different now to the resale value of your phone, which you have stayed for 5 years or 10 years, right? That is why you can see when we are reselling the machine at year 1, the resale value is more compared, right? It is more compared to year 2, compared to year 3, and compared to year 4, right? Because when we are reselling the machine at year 1, it had a resale value of 15,000. When it go to year 2, we sold it at 10,000, right? When you went to year 3, all the resale value of the asset, because of the wear and tear and all the other implications involving the machines. Now, what we are doing right now, when you are reselling the machine and you are calculating, for example, the 2-year replacement cycle, you're not going to be saying, can I capture the resale value for year 1? Then when you are reselling at year 1, it means you cannot be able to reach at year 2, because ukiuzia hapa inamaanisha itafika hapa, hautakuwa na resale value. We cannot have 2 resale values under this replication criteria which we are using under our computations. So if, for example, we are reselling at year 4, the only cash inflow we can be having is 2,500. The others will be remaining as costs. And that is why you can see we have the net cash flow, because the resale value at the end of year 4 is too low. And that is why you have been seeing when I'm doing the computation, if we were to come here, for example, this was year 3, and you say, can I resell at year 1? Let me capture the resale for year 2. If you resell it at year 1, you cannot resell it again. Ukiuza hiyo simu si yako tena. It belongs to someone else. Have you understood? Have we understood? The person who was asking a question. Have you understood?
Yes.
Very good. Now, let us now compute the NPV of this project. But don't forget to capture for me this one, right? Capture for me that one. Capture for me that one. Okay. Very simple here. It is a very simple concept. Huwezi uza simu hiyo yako nimekwambia. Hiyo yako umeshika hapo. Ati uiuze. Alafu useme, mbona nisikapture resale ya? No, ukiuza kitu tena si yako. Right? Umeuza, hiyo ndio ilikuwa resale value under the valuation, then it doesn't belong to you once again. That is why unaona tunaruka the resale value for respective years. Sisi tunafanya discount factor here at the rate of 10%, we get the present values. So we have here 0, 1, 2, 3, and 4. The cash flows of ours ni ngapi? Year 0 negative 25,000, negative 7,500, negative 11,000. We have negative 12,500. Then the last one is negative 12,500, right? The discount factors here, you know, for year 0 is 1. For year 1 is 0.9091. This I was told is 0.82 to 0.8264. The other one is 0.7513. Then what is the discount factor for year 4?
0.6830.
0.6.
830.
They have said is 0.6830. So this one, it remains negative 25,000. The second one is how much? The second one we got negative 6818.25. For year 2, which is negative 11,000, we got negative 90.4. Then we have here 3. How much is this? Right.
Negative 9391.25.
Negative 391.25.
25.
25. Very good. Then we have the last year. Negative what?
85.37.667.
Okay. What is your NPV at year 4?
85.37.5.
It is okay. What is our NPV? Thank you.
0.6678.
Yes, sorry?
0.67. 85.37.67.
Thank you so much. Thank you so much. So what is the equivalent annual values? Nataka upate pale so that we can calculate it and we advise. That's swali imekwisha. Chaelewa hiyo concepts. Swali yako unaimaliza namna hii. What is the summation? One is
Negative 58,837.4.
negative, umeniambia 58, 837 point something.
0.4.
It should be 4 years. So let us get the EFV for the first year. For year 1. So we are going to be taking, when you look on the computation of the NPV for the first year, we got around 32,000. I'm just copying somewhere. 644. You divide it by what? What is the discount factor for 10% 1 year? The present value to P5 fire 1, they are 10% 1 year. Ingapi? %10 1 year. 0 points.
0.091. 0.9.
Yes, 0.9091. Yes, but our first answer was around negative 18, 181.75. Right? What is your EFV for the first year? All right. Is that how much? is around 20,000. Are we together? Is it 20,000? It should be around 20,000 there. 19,999. When you round off, you'll be able to get 20,000. Now, let us look on the EFV for the second year.
One more question.
Yes.
Your formula down there, you've written EAV NPV over present value interest factor annuity. Is it
10%
annuity?
1 year. Kwani ukichukua
Then
1.1 you raise for -1, 1 minus answer, then you divide it by 0.1, you're going to be getting that one. The formulas for lump sum and annuities, by the way, for the first year, zinakuanga similar.
Oh, okay.
Have you ever identified that? Hata enda uangalie kwa hizo tables, you'll be finding this. Now, for the second year might be looking different because when you take the NPV for 2 years, the NPV was -32, 644.45. We divided by what? Now we are discussing about 2 years. We are discussing about 2 years. What is our discount factor? What was our discount factor there? Someone? Hii ni ngapi? For 2 years now.
1.7355.
Aya, nipe EV yake. Equivalent annual value. How much? Unajua nakumbuka wakati when I was in class, we used to like to answer questions. We used to like to answer questions. So, when you speak a lot, when you speak a lot, these things sticks. When you keep quiet, na nyamaza tu, you cannot be able to digest something. You have to show your mind that you are in class. So EAV for 3 years. Haimaanishangi eti uko wewe ni mjuaji, hapana. Nataka tu put some senses. Uzionyeshe uko daru. Now for third year, the EAV, the NPV was around -44,665.15. Then you divide it by what? You divide it now for 3 years.
2.4868.
Very good. So how much is your EAV? How much is your EAV? Negative what? Negative 17,000?
0.96. 17,096.60.15.
Thank you so much. It should be negative 17,960.15. Then let us calculate the EAV for 4 years. Right? The EAV for 4 years, what can we be able to say? We take negative 58,837.4. We divide it by what? We divide it by the present value interest factor annuity, 4 years.
3.1698.
I have not captured it well. 3.16, pardon. 3.16.
3.1699.
0.1698.
Thank you.
998.
Now, what is the EAV? Thank you so much.
Yes.
Sorry? It should be negative what? There should be negative 18,561.28. Negative 18,561.28. And we said, when you are making these decisions here, we said where these approaches basically used, it is assumed that each project will replicate with the same cash flows in each cycle over their shortest common periods. And for this reason, the NPV of a project in each cycle shall remain constant. The net present value of both projects is determined, and then the project that promises the greatest net present value. When you look at them, which promises the greatest? Which normally promises the greatest net present value over their shortest common period shall be recommended. Which one can you be able to recommend there?
Second year.
Someone has said second year. Anyone else?
Yes. Yeah.
Sorry?
Year 3.
Esther, Zima video. What can
Good.
Let me say this. The optimal replacement cycle. The optimal replacement cycle should be which year?
Year 3.
3 years. Very good. The 3 years is the one that has the least equivalent annual value. Remember now you are dealing with negatives. Unaangalia the one which is as the least. And we say this is the point where is a point where the annual net cash outflow shall be minimized. That is an area where we are going to be minimizing, the cash outflow. And that is how the question is normally done, under the replacement criteria. Any question? Any question there? Najua mna swali. Now, let us incorporate inflation in capital budgeting. Right? Najua kila mtu saizi, we're discussing about the cost of the commodities in our supermarkets, in sijui wapi, mambo imekuwa ngumu, mwalimu, and so on and so forth. And what I can be able to see the discussion today, and I don't know whether this discussion should be channeled to the government of Kenya. The people now are discussing about how the government was able to achieve its objective by playing which role by reducing the dollar exchange rates. I don't know whether it is the role of the government to increase or to decrease, to weaken the currency. But sometimes it is very important for us to understand what inflation is all about. Someone to define what inflation is. What is an inflation? What do you think inflation is? Right? Now, let us discuss the aspects of what inflation is all about. What is an inflation? What is an inflation? What is 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 inf And when you're discussing this inflation, you can just be able to say inflation. No. Okay. When you look at this aspect of inflation, its meaning in economics, the inflation basically talks about the rising of commodities, the price of commodities. And we are saying this can be translated as the decline of the purchasing power over time. And when you look at it in a different terms, you can say it is the rate at which purchasing power drops and can be reflected in the average price increase of a basket of selected goods and services over time. But when you put the same question again about what are some of the causes or the factors that can cause a currency to lose the value, is how we could be able to attest in the last 14 months, you can be able to give it as one of the key things by saying that the inflation will be able to reduce the value of money in a certain country. And if there is a rampant inflation, then it means that a currency will depreciate in value. And the other aspect which you can be able to see, it is the current account deficit. And we are saying that a current account deficit means that a country imports more goods and services than it exports. Because basically you can be able to see and rates which which one of these basically makes sense in terms of the savings, which one is cheaper between the importation and the exportation. And when you're exportation, and if you're exporting using dollar, and then it is affected by the inflation, it means the export rates will be they are going to be more expensive. Then you can be able to talk about the collapse of confidence, like what we could be able to see. The investors who are able to now gather, you can see the investors are gathering some confidence with Kenya because of how the government was able to maintain. When you look at it, how they were able to maintain the aspect of the Eurobond and so on, will be able to spearhead those aspects of economy and so on. I think we are going to be experiencing more debates as we move forward. The other thing, we look on the price of the commodities and the more the price of dollar. And because we cannot be able to make anything, even a toothpick, our country cannot be able to manufacture even a toothpick, then it means the price of those commodities keeps on increasing because we import everything. Now, let us look on the economic fundamentals, right? And then we look on the interest rate differentials. I could see now people, Kenyans, as per today's publication, which was made today, you could be able to realize that Kenyans were holding around 4 billion US dollars in their accounts, so that they are waiting for the weekend of the Kenyan currency to hit around 200, then they can be able to cash out their dollars there. You could now be able to see, for example, I was sharing this information with my friend, and he was able to tell me that when you look on some of the forex shops, these normally, a lot of people normally go to exchange they are buying the dollars right now at 130, so that they can be able to sell it around 140. Because around 4 p.m., the dollar was trading at around 140 and against US dollar. You're going to be enjoying some of the aspect of the international financial derivatives. But we are saying here, under the incorporation of the inflation in capital budgeting, we are saying where there is inflation, there will be an increase in price levels and reduction in purchasing power. Where inflation is high, there will be an increase in the nominal revenues and costs. However, the cost of capital and debt obligation remain unchanged. When making investment decisions under conditions of inflation, there are two alternatives adjustments that can be done. Number one, we can be able to talk about adjust the cost of capital for inflation, or that is determine the inflation adjusted discounted rate in order to include an allowance for inflation premium, or we can be able to adjust the net operating cash flows in each year for inflation. We're just going to be checking on that as we factor our illustration. But we are saying both approaches are expected to provide the same net present values. And we are saying the relationship exists between the cost of capital in money terms, inflation rate, and inflation adjusted cost of capital can be expressed in the formula you are able to see there. We are talking about R is equals to 1 plus M divided by 1 plus J minus 1, where the M is the cost of capital in money terms, J is the inflation rate, R is the inflation adjusted cost of capital. Very simple. Now, let us look at because we have to be looking on an illustration here, whereby we are going to be factoring both, right? We are going to be factoring both concepts. I just want to look on the both concepts between the first one and the second one. I just want to share something here with you. Let me check on that something. Before someone, I can see there is someone who wants to ask me a question. Someone to ask a question? Someone want to ask a question? What is the question? Let me look at a question which you tested on 2020. Let us look at 2020. There is a question there which we can be able to discuss, and we look at how and is it hard or easy to do that kind of a question. Kuna makaratasi ya blue unaona mahali. So that is the question for 2020. So let me check on it, please. Nikipata hiyo huwezi elewa, I'll just be able to come up with my question. All right. Question 1B. We are there now. Is it 1B? No. It should be question number. Let me just check well, but it's in 2020. It should be 1C. 1C, sorry. 1C. Nimesema this one should be the easiest thing to pass in an exam. Someone read, please.
Chanzo Limited is considering a project which would cost 5 million now. The annual benefits for 4 years would be a fixed income of 2.5 million per annum plus other savings of 500,000 in year one, rising by 5% each because of inflation. Running cost will be 1 million in the first year, but would increase at a rate of 10% each year, including 10% each year because of inflating labor cost. The general rate of inflation is expected to be 7.5% per annum, and the firm's required nominal rate of return is 16% required. Advise the management of Chanzo Limited on whether to undertake the project. To comment on the impact of inflation in C1 above.
Before we do that question, let me give you a break. A break of 2 minutes. Swallow our water there, right? 2 minutes. So when you look on this illustration rather than the one that we were reading for 2020, let me just give you 4 assignments. Let me do this for better understanding. Then I need you to do 2020, and then you share with me through the WhatsApp group. Now, Kukina Limited is considering buying a machine that is expected to cost the company 2 million Kenyan shillings. We are saying that this investment is expected to save on both material and labor each year. it is expected that the annual savings in labor and material costs are expected to be 200,000 and 150 respectively. But we are saying that the machine is expected to have a useful life of 5 years with no resale value. The inflation rates used to adjust labor and material cost savings are already given there. We are being given 10 and 8% respectively. And we are being told that the annual inflation rate is expected to remain constant each year. And then the cost of capital is already provided in the question, which is 10%. And then we are being told to ignore the effects of taxation. It is not about inflation. This should be, we ignore the effects of taxation. We ignore the effect of taxation required. We are being told if we can be able to use our NPV method, can we be able to advise the Kukinya Limited whether to undertake the investment or not, right? The first thing that you're going to be doing here is factoring the inflation rates, right? We are going to be using the inflation adjusted, not cash flows. And in this case, when you look at it, let us look on the inflation adjusted for. Let me start with the inflation adjustments. And I'm going to be starting with one thing here. You're going to be starting with material cost savings. Material cost savings. Now, the project you're being told is going to be taking 5 years, right? It's going to be taking 5 years. Now, in this case, if it is going to be taking 5 years, will my 5 years fit here? Can I say no? So wacha nikuja hapa niseme material cost savings. Right? Material cost savings. So each year, how much are we going to be saving? I can see we were being told we are going to be saving 150 for material. Or how much is it? Yes, it is 150. So we have 150, 150, 150, 150, 150, because our project is going to be taking 5 years, correct? So what is the rate of inflation for material? It is 8%. So you just say, can I be able to compose this for future value? 1.08, you raise power 1, 1.08, power 2, 1.08, power 3, 1.08, you raise power 4, 1.08, you raise power 5. How much are you getting here? How much are you getting there? You're kuna mahali, but you can be able to hear my voice. How much are you getting there? Then you do the same for the labor cost savings. Labor cost savings. You do the same thing here. The labor cost savings, you have 200,000. 1.1, you raise for 1. I think it should be 10%. The other one will be 200. 1.1, you raise for 2. 200, third year. 1.1, you raise for 3. 200, year 4. 1.1, you raise for 4. 200, 1.1, you raise to power 5. You raise for 5. You raise for 5 there. So how much are you getting there? Sorry, I want to start with the material cost savings. Sorry for the small challenge I can see there. How much is this?
162.
162.
The
Continue.
first one. 174.96. 188.96. 204.07.
204.07.
To 20.4.
320.4. What about the
220. Not 320.
How much is it?
The last one, it's 220, not 320.
220.
Yes.
Thank you. Let us go to labor. This is 220 or something. What about this one? The second one? The second one is how much?
242.
242. Third one?
266.2. 292.8.
Sorry?
292.8.
And the last one?
322.1.
Acha wale swali na
22.1.
ushamaliza kufanya namna hiyo. Can you take your years, eh? You have cash
It's
flow,
22.
right? Discount factor at 10%, you get the present value. Eh? So you have your 1, 2, 3, 4, and your 5. Eh? The cash flows now you take the summation of the two. 162 plus 220. Unapata something like 382. Unaweka hapa. The other one ni ngapi? Next.
Mwalimu, labor cost savings. The last one, it's 322, not 324.
Which one?
The last one on labor cost savings.
Thank you.
Yes.
So 382, the other one? Hello, next. 174.96 plus 242 is how much? That is what I'm asking. Let's do quickly, please. I just want to finalize this.
416.96.
The other one? $455.16
Yeah.
plus 292.8, getting 496.87. The other one will be 220.4. We add 322.1. Someone to give me the discount factors. The discount factor for the first is how much?
0.9091.
The second one?
0.8264.
86.
8264. If I'm not wrong. Yeah. The third one is 0.7513. 0.6830. Let me
The last one? 0.6209. So let me start with the first one. Yeah, I'm getting 347.28. The other one will be 416.96 times 0.8264, getting 344. 344.58. 455.16. We multiply by 0.7513. 341.96. The other one will be 496.87. We multiply by 0.6830. Getting 339. 339.36. Someone give me the summation, please. How much is the summation? How much is the summation there? Summation is how much? Hakuna mtu mmechoka kabisa? Mmechoka kabisa?
1710.02.
Is that correct answer?
Yeah.
17?
10.02.
1710 points.
02.
Then we less our initial play. Our initial play is how much? Our initial outlay should be, let me just look for a small initial outlay here by putting 1 million. Let me just put 1 million here. Just want it to make sense for you. So the initial play of 1,000, what you're supposed to be getting here, NPV, should be 710.04. 710.04. Alternatively, you can be able to apply this formula here. Someone is telling me something. Where were we getting the DP? What is the DP? I don't have the DP here. Deputy President is not here. These are the discount factors. And the discount factors we apply using a formula called, one is you are being at in my class. So unless you have not been watching the other videos. So 1 plus R you raise for negative n. So for example, the first one we have got it by taking 1 plus 0.1, we raise for negative 1. The second one has been 1.1, you raise for negative 2. All that way. That is how we were able to get the discount factors. Now, when you're using this formula, rather than using all that, we are talking about using the inflation adjusted cost of capital. This is the formula for it. To get the inflation adjusted cost of capital, we are going to be using our M. Our M, we have said, it is the cost of capital in money terms. Then our J here should be the inflation rate. For example, when you look on the question which we have here, and we want to calculate the inflation adjusted discounting rate for material cost savings. So in this case, for example, here, I should be talking about the material cost rates. So how is the formula applicable? So 1 plus the cost of capital, that is the one that we are talking about, the cost of capital in money terms, which is 0.1. You divide it by, right, 1 plus the rate for, we are talking about the inflation rate for the material cost. We were able to see it somewhere, which was around 8%, 0.08. Then we subtract 1, right? So in simple sense here, we're going to be having 1.1. We divide by 1.08 minus 1. What is the answer?
0.0185.
Sorry?
0.0185.
1 minute. Someone has told me it should be 0.01. If you multiply by 100%, let us put in 100%. What is the percentage? What is the percentage? What is the percentage? It should be around 1.85%.
Yes.
Right? 1.85%. Then you can also be able to calculate the inflation adjusted cost of capital for the other one, for labor. So in this case, it means this was for the material. So let us do for labor. And for labor, it will be 1 plus 0.1. You divide it by what? 1 plus, this rate was how much? Let me look on that rate, which was 0.1, minus 1. I don't think whether it will be able to make sense for me. 1.1. We divide by 1.1, minus 1. I don't want to have a zero rate. So let me say about, let me just make a small adjustment here because it was just my example. So let me talk about 12%. If it was 12%, for example, I just want this to have a difference with the cost of capital. So how will it look like? So you could be able to come and to tell me, I just want to show how the formula normally works. The cost of capital is 0.1. You divide by, now let us say our rate for the labor was 12%. So in this case, it will be 1.1. We divide by 1.12 minus 1. How much is this? 1.1. You divide it by 1.12 minus 1.
Negative 0.0178.
Negative, sindio? Let's talk in
Yes.
negative. Let me talk about 16%. Sorry for the adjustments. Sikuwa nimeangalia that aspect. 16%. 16% here. How much are you getting?
It's still negative.
It's negative.
Yes, to 7 or 8.
Leave it there. Let me put this 10. Let our cost of capital be 16. So here should be 16. This, let it remain 1 now. How much are you getting? How much are you getting? How much are you getting here? If you take 1.16, you divide by 1.1 minus 1. I'm talking about something closer to 5.5 now. 5.5%. Wakati umepata, because I'm just giving an example. The moment umepata is the rate to begin. The moment you have gotten these rates. Now, to say, for example, they are the same rate which you use to compute here. Let me talk about the first one was 8. The other one was 10%. Then the discount rate here, we worked with 16%. And then also you apply this formula, you're supposed to be getting the same answer. Again, I have said, if our discount rate here was 16 as we have changed it, right? And then we have applied all the other concepts and they have remained constant, then when I'm calculating my NPV, when you look on your NPV, should be looking like this. These are how the NPV should have looked at. Sorry for that. So when you look at your NPV, you could have come and told me, Mwalimu, we are going to be taking, for example, the saving for material cost, which was 150,000. We multiply by the present value interest factor annuity. Now, the rate which we are discussing is 1.85%, 5 years, right? Plus 200,000. We multiply by the present value interest factor annuity. We have talked about 5.5%, 5 years, minus our 1,000. Minus our 1,000. These answers should be similar. Kama umetumia hapa 16%. Remember our cost of capital, we have used 10%. And that is where you could see the inflation adjusted cost of capital. In other cases, we are getting a negative. But if we could have used the cost of capital here, and you can just go and repeat by yourself, then you could be able to see, because the only changes that you're going to be making is on the discount factors. We put here 16%. The other that you're going to be getting there should be at the same answer you're getting from the other end. Remember also here, the cost, this one will be changing because we use 10, the cost of capital of 10 rather than 16%. And that is not a problem. I know that the concept you have already understood, or now you normally factor the inflation and so on and so forth. So if, for example, you apply the two different methods, if you apply, one of the students apply this one, the other one applies on the adjustment of the cost of capital, then you should be getting the same answer. Assignment here, assignment, we are talking about just go and do November 2020 question number 1C. November 2020 question number 1C. Just go and try and do that question. Now, topic 1 is done and dusted. Topic 1 done. Topic 2. Topic 2, we are going to be starting portfolio theory. Portfolio theory and analysis. And I know because most of you, they don't attend the classes, don't come for the portfolio theory. Because you don't attend classes, you see come up with a portfolio theory. Tata tupatane pale. And I will be able to make sure I will finish it by Thursday next week. Next week, tutakuwa tuna run, tutakuwa hapa tunatoa fire, tutakuwa tunawaka fire in that level. Hapa we will work a lot to get into the statistics a bit. So let me stop at that point unless there is any question.